Welcome. Today, we're putting on our detective hats. Why? Because we're about to uncover one of the biggest and most misunderstood secrets of the modern economy, how the money we use every day is actually created. And trust me, the culprit is not who you think it is. Our investigation kicks off with a really simple clue. You deposit 10,000 rupees into your bank account. Now, you probably imagine that money just sitting in a vault somewhere, safe and sound with your name on it. But the reality is so much more dynamic and, frankly, way more interesting than that.
Okay, to crack this case, every good detective needs to understand the evidence. And for us, that means knowing there are actually two kinds of money. First, there's physical currency, the actual notes and coins you can hold. And let's get one thing straight right away, your local commercial bank does not print this. That's a job strictly for the central bank. But here's the kicker. The vast majority of money, we're talking over 90% of it, is actually bank money. It's just the digital numbers you see on your screen.
All right, our investigation begins now. Let's follow the trail of that 10,000 rupee deposit. We're going to go step by step to see exactly where this first clue takes us. Here it is, Exhibit A, our primary piece of evidence. This single deposit is the seed. It's the little spark that's going to kick off a massive chain reaction throughout the entire banking system. Now, your bank doesn't just stick that money in a drawer. There are rules. It's required by law to keep a small fraction of it. For our case, let's just say it's 10%, or 1,000 rupees. That's called a reserve. But the other 90%, that 9,000 rupees, the bank is allowed to lend that out. And this is the crucial point, so listen close. When the bank gives someone that 9,000 rupee loan, it doesn't just hand them a stack of your cash. Nope, it simply creates a brand new digital entry in the borrower's account. Poof! It's like adding a new line to a giant, ever-growing digital receipt book. Just like that, new money exists. And right there, that is the first magic trick. Just look at the numbers. Your original 10,000 is still showing in your account, right? But now there's a new 9,000 in the borrower's account. So suddenly, we have a total of 19,000 rupees of bank money in the system, all created from that one initial physical deposit.
But wait, it doesn't stop there. Not even close. That new loan isn't the end of the story. It actually creates an echo, a ripple effect, that just keeps multiplying money all through the financial system.
So let's follow that echo. The person who borrowed the 9,000, well, they spend it. The shopkeeper who receives that money then deposits it into their bank. And what do you think that bank does? You guessed it, it keeps its 10% reserve, which is 900 rupees, and then lends out the rest, creating a brand new loan for 8,100 rupees. And the whole cycle begins all over again. This incredible cascading process of lending, depositing, and then relending has a name. It's called the money multiplier effect, and it's the core engine that allows our banking system to expand the money supply. With that 10% reserve rule we've been using, every single physical rupee can eventually support up to 10 rupees of total money in the economy. Pretty wild, right? Okay, so just when you think you've got the case all figured out, our investigation has just uncovered a massive plot twist. You see, the simple model we just walked through, that's how it's often taught in school, but it's not exactly how modern banking works. We even have testimony from an expert witness, the Bank of England itself. In a really important paper, they confirmed a detail that completely flips our old story on its head. It turns out, banks don't actually wait for you to deposit money before they start lending. So here is the modern reality. When you go to a bank and get approved for a loan, the bank creates that loan and the deposit for you at the exact same time. The deposit doesn't come first. In a very, very real sense, the act of lending is the act of creating money from scratch. So, if commercial banks have this incredible, almost magical power to create money, who's in charge? Who's pulling the strings to make sure things don't get out of control? Well, our investigation now leads us to the mastermind of the whole system, the central bank. You see, the central bank, like the Reserve Bank of India, doesn't just let this happen randomly. It has a whole toolkit full of powerful instruments to influence just how fast or how slow commercial banks can create all this digital money. It's all about keeping the system in balance. And their main tool? It's the interest rate, specifically something called the repo rate. Think of it like the gas pedal for the economy. When the rate is low, it's cheaper for banks to borrow, which encourages them to lend more, and that speeds up money creation.
But when the rate is high, it's like hitting the brakes. Borrowing gets expensive, and money creation slows right down.
Okay, so we get the mechanism now, but our investigation isn't over until we understand the stakes. What are the real-world rules, the regulations, and, the dangers involved in such a powerful system?
That simple 10% reserve rule we used, it was a great way to learn, but in the real world, it's a bit more detailed. In a place like India, for example, banks have to follow rules like the cash reserve ratio, or CRR, which is the bit they must hold as actual cash. And then there's this statutory liquidity ratio, or SLR, which forces them to hold another portion in super safe, easily sold assets like government bonds.
But you know what? Today, regulators are focused on something even more important. It's called capital adequacy, under international rules like the Basel norms. This is all about making sure the bank has a big enough financial cushion of its own money, not your deposits, to absorb big, unexpected losses. It's less about reserves and more about making sure the bank itself is strong enough to survive a storm. So why does controlling all this matter so much? Well, it's actually pretty simple. If the banking system creates way too much money way too quickly, and the real economy of goods and services doesn't grow to match it, well, you get more money chasing the same amount of stuff. And that, my friends, is the classic recipe for inflation. Think about it. If there are only 10 cars for sale in a town and suddenly everyone has twice as much money, what happens? They just bid up the prices of those same 10 cars. The cars didn't get better, the money just became worth less.
The system's biggest weakness, its Achilles heel, is a loss of trust. If people get scared, maybe because of a rumor, and everyone rushes to the bank at the same time to pull out their physical cash, that's called a bank run. And that's when the whole digital illusion can shatter, because the bank only holds a tiny fraction in actual cash. The system can literally fail. To stop that nightmare scenario from happening, there are two crucial safety nets in place. First, there's deposit insurance, which guarantees that your money is safe up to a certain limit, so you have no reason to panic. And second, the central bank acts as the lender of last resort, standing by, ready to pump emergency cash into any struggling bank to keep the entire system stable.
And with that, our investigation is closed. We've pulled back the curtain on the hidden mechanics of how money is really made. But it leaves us with one final big question to think about. Is that digital money in your bank account truly real? Or is it just a promise, an entry in a ledger, all held together by a fragile but incredibly powerful system of trust?